Hello and welcome to this weekend's market update. Today is 11th of February. You're looking at a daily chart of S&P 500. S&P 500 closed slightly in positive territory on Friday. If we look at the chart pattern right now, what we see is that you see that since reaching this low right here, it has been making a series of higher low, and this structure is still intact despite this pullback this week. This sequence of higher low structure still remains intact. If we look at the momentum indicators, we can see that RSI, it was in overbought territory last week. You can see it was around 70. So this pullback has release some of the overbought condition, but it still remains above the 50 level. This horizontal line is the RSI 50 level, so this is in positive territory. MACD is above the zero line, which is positive, but you can see that it's beginning to kind of cross over. Now the crossover is fine so long as it remains above the zero line. So for the moment, this crossover is indicating that perhaps there's some consolidation that needs to happen at the moment. And if you look at stochastic remains above the 50 level. You can see that 50 level was a resistance right here. It was a support right here, resistance right here, resistance right here. So this 50 level, halfway level is important. So if it stays above this level, that would be positive. If it falls below this level, it suggests that there might be a little bit more weakness to come. Now, if we look at the moving averages and see where they are in relation to the current price, you can see that at the moment the price is above all three moving averages. The black one is the 200-day moving average, the green one is the 20 EMA, and the yellow one is the 50 EMA. So at the moment, the price is above all of them. And what happened this week is that the price had moved away from these moving averages, and this consolidation pullback just brought it to the moving average. So in a way, you might say this is healthy. In fact, if you look at it, since this rally started, it found support at the moving average right here, then again right here, and again right here. So these moving averages act as dynamic support. So at the moment, they have now come to the 20 EMA, but remains above the three moving averages. So that is positive. So overall, daily chart remains more positive than negative. And what this week's consolidation pullback has done is brought it to the moving average. Now, if we quickly look at the weekly structure just to see what we see, from a weekly point of view, you can see that it remains above the weekly 20 and 50 EMA, and the 20 and 50 EMA you can see are beginning to kind of turn right here. They haven't crossed yet, and the price remains above the moving average. The longer the price remains above these two moving averages, the more relevant this break above the moving average would be. You'll notice that right here, it went above the two moving averages, but then wasn't able to stay above there. It fell back. You can see right here also same thing happened. So we need to see whether or not this can stay above the moving average. The longer it stays above this moving average, the more relevant this break would be. If you look to the left right here, when it was coming out from COVID, you'll see that once it moved above the moving averages, the moving average, it spent quite a bit of time at that level consolidating. So the question is whether it would do something like this. Well, we'll find out in coming weeks. I mean, if you look at Dow, what you'll see Dow is that Dow also had a big rally. It had gone above the two moving averages, and then it's been consolidating above the moving averages. So this is much more constructive. So the question is whether S&P 500 SPY would do the same. If you look at the momentum indicators on a weekly basis, you can see RSI still remains above the 50 level. MACD is heading higher. It is now at a very important level from it's at the zero line. If it crosses above the zero line into above, that would be positive. Something like what happened when it was coming out of the COVID lows right here. It's not completely there. See, the blue line is above, the yellow line is not yet. So if it continues to if both the lines are above, that would be positive. So overall, the weekly picture remains more positive than negative. You can see on the price, there is a clear higher low being established. So this is more positive than negative. So coming back to the daily chart, the question now is, okay, fine. So we see all of that. What can we expect next week and beyond? Now, in order to answer that question, I think we need to see, from a news perspective, economic data perspective, what might be, coming ahead. And we also have to look at the bond market to get some guidance. So let's quickly have a look at the bond market and see what do we see there. So if we look at the 10-year bond yield, so this is 10-year bond yield. So you see, since the unemployment report was released on 3rd of February, you see this green candle right here. So this was the day the unemployment report was released. You see this red candle right here. This is 1st of February. This is when FOMC meeting was. After the FOMC meeting, yields actually fell. But after the unemployment report, which came in above expectation, the yields have been going higher. The jobs report was actually fairly strong, and as a result, market is now expecting that the Federal Reserve may have to increase interest rate beyond what was previously expected. Previously, market was expecting Federal Reserve to pause once they increased the Fed funds rate to 5%. But after the unemployment report was released on 3rd of February, that expectation has now changed. Market is now expecting Federal Reserve to increase interest rate to 5.25 before pausing. If you look at this one, if you look at the this is the Fed funds futures for September 2023, that closed on Friday at 5.17%. So market is definitely expecting Federal Reserve to go above 5%. So obviously that would be 5.25. The question is, can Federal Reserve go above 5.25? Can they go up to 5.50? Well, it is possible, but that would depend on what may happen next Tuesday. So let's talk about the economic report that's coming out next Tuesday. 14th of February, we're going to get the inflation report for the month of January. At the moment, market is expecting inflation rate to come in at 6.2%. Last month, it was at 6.5%. So slight move to the downside. But if you look at the trend, you'll see that for the last few months, inflation rate has been dropping fairly in large chunks. You can see from here 8.2 to 7.7, that was a 0.5% decrease. From 7.7 it fell to 7.1, that's a 0.6% decrease. And then from 7.1 to 6.5, that's another 0.6% decrease. Yet this month we're only expecting a drop from 6.5 to 6.2. So that's 0.3% decrease, which means that we're expecting some slowdown in the pace at which inflation rate was declining. And that is because if you look at this number, if you look at the inflation rate month over month, you'll notice that last month inflation rose just 0.1%. This is from November to December. But from December to January, the monthly increase is expected to be 0.4%. That's quite high actually. If you look at this shows the monthly increase. You can see that last month we had an increase of 0.1%. So this month, this is December, in January, we're looking for monthly inflation increase to be up here, 0.4%. Now, if you look at last 1 year, majority of the time, monthly inflation has been at 0.4% or higher. So if we get another reading here in January of 0.4, that would be 1, 2, 3, 4, 5, 6, 7, 8, 9. 9 months, in the last 12 months, 9 months would be 4% or higher. Now, if monthly inflation averages around 0.4%, that annualizes to almost 5% inflation, annual inflation of 5%. That is way too high. The monthly inflation should not be more than 0.2%. If inflation every month goes up by 0.2%, that annualizes to 2.42%. So monthly inflation increase of 0.4% is way too high. As you can see, that majority of the time it has been at least 0.4 or higher. Even though we've had readings of 0.2, that's been that has been consistent. So Federal Reserve would like to see monthly inflation increases no more than 0.2. If it came in at if monthly average is 0.3%, that's around 3.67% annually. That's still a little bit tolerable. But 0.4, that is high. That is like high. So it would be so this jump, monthly jump from 0.1 to 0.4, in my view, is not good. If you look at the core month over month, that was 0.4% last month, is expected to be 0.4 in January. This is December, this is January, which means that the core is not likely to come down. And at 0.4%, if you analyze it, that's around 5%. So the core, there doesn't seem to be any kind of moderation in the inflation rate in the core on a monthly basis. So although the core is expected to drop slightly, but I don't know that 6.5 to 6.2 is a significant, it's a progress, but I don't know that this is a significant progress. I think if the number comes in at 6.2, there could be some disappointment. Especially given the fact that it was dropping fairly in large chunks, 0.5%, 0.6%. From there, if we go to just 0.3% decrease, I'm not sure that the market would be thrilled about it. And especially knowing that the monthly inflation jumps from 0.1 to 0.4. So I think if the inflation comes in at 6.2, market could be disappointed. 6.1, okay. Anything below 6.1, market might rally, but at 6.2, I'm not sure. But it is what it is. So let's come back to our analysis. So if inflation comes in at 6.2, I won't be surprised if yields continue to move higher. So 525 is what the market is expecting, but I think a slightly stronger CPI report might suggest that the market might be thinking about 5.5. 5.5 hasn't yet hasn't been factored into the market, and people haven't been thinking about 5.5. But unless we see inflation drop quite a bit, gradually that might start to creep into the conversation. So something to keep an eye on. So coming back to the 10-year, so the 10-year, as you can see, it's been rising. It's been rising. I think the key level for 10-year is this level right here. You can see that the 10-year has been making a sequence of lower highs. High, lower high, lower high. But if it breaks through this level, which is 390, I think this could potentially cause a problem in the market. So coming back to my SPY and S&P 500 analysis, so let's now talk about what are the levels we should be looking out for if the number comes in hotter than expected. First of all, at the moment, from a moving average point of view, it remains above the moving averages. If it falls below the moving averages, then I would be concerned, because this trend which is, sequence of higher lows, is going to break, and these moving averages will then start to move lower. So what is that number? The 200-day moving average is at 39.44. If it closes below 39.44, I think that would be a problem. And what that would basically mean, that the momentum indicators would go into negative territory. RSI for sure will fall below the 50 level, MACD will cross and most likely head towards, the zero line, and possibly even go below the zero line. If it does something like this, then I think there would be a problem. But if the number comes in at 6.1, and these levels are not breached, then I think the overall structure remains intact. So we need to pay attention to where the price is in relation to the moving averages. So that's number one. So the key one is the 200-day moving average, which is 39.44. Below that, I see problem. If we look at some horizontal levels, just to see, so let's have a look at the horizontal levels. Now, so this is, 40.60 is the near-term support level. And then below there, we've got 40.10, 40.50, which is this level. And below this, then we're looking at 39.29 right here. Now, if I bring the moving average, you would see that the 200-day moving average is right here. So if it falls to this level, then it will go below all the moving averages. So ideally, it should hold this level, which is where, see the current level, which is, see where the red line is, that's where the 20 EMA is. So there is some support right here. But if this level is breached, then this level, which is 40.15, would be the next level. And then the 50-day moving average that comes in. And then you've got 200-day. So these would be the levels to watch out on the downside. Now, let's look at on the upside. On the upside, we need to get through this level, which is 4100, and finally 4200. So those would be the levels I would be looking out for. If we look at SPY, just to see what are the corresponding levels. So for SPY, Friday's low, which is around 405, would be the near-term support, and then this level right here, which is 400. Those would be the two near-term levels, and this obviously 420 would be the resistance on the upside. And then we've got the moving averages, so we need to see whether or not the moving averages are breached. So if it closes below the 200-day moving average, which is around 394, then obviously this current structure would look much more bearish. So that's SPY. If we look at NASDAQ and QQQ, what do we see? So if we look at the moving averages, you can see the moving averages are down here, right here. The price remains well above the moving averages. So this correction, has brought price closer to the moving averages. The 20 EMA is around 12,113. There is some support right here, which is around 12,200, which is this line right here, and then the 20 EMA comes in, and then you've got the 200-day moving average. The resistance, the first resistance is around 12,400, and then 12,650. So those would be the resistance, and finally the previous high, which is around 12,900. So those would be the levels to look out for. And the corresponding levels for QQQ. So the near-term support is around 297. Then you've got the moving averages, the 20, the 200. 200-day moving average is around 291. The resistance is this one, which is around 313.50. So that would be the resistance. But I would see whether or not it falls below the 200-day moving average, which is around 290. So those would be the levels to watch out for. But I think the CPI is very important. The reason why it's important is because since the unemployment report, the narrative in the market is that the labor market is still strong, inflation is still going to be sticky, and Federal Reserve may have to do more. The CPI report can either validate this or invalidate this. If the CPI comes in weaker than expected, then people might say, maybe the jobs report was maybe it's one-off. How can the economy create over 500,000 jobs? But if the CPI comes in stronger than expected, then I think this narrative will remain, because after the CPI, we don't have the same reports until early next month. You see, because the market is now going to react to the unemployment report and CPI report. Yes, there'll be other reports coming, but I don't think the markets are going to react the way they react to the CPI and the unemployment report. After the CPI report next Tuesday, the next unemployment report will be early in March. Yeah, we're going to get GDP report and PCE report and retail sales, but I don't think they're going to be market movers. So what's going to happen is that after the CPI report, if it comes in stronger, there'll be a narrative in the market for 3 weeks that inflation is going to be stronger and sticky, and that's going to create a negative bias on the market. But on the other hand, if the report is weaker than expected, then obviously the market might think that the Federal Reserve doesn't have to go to 550, they can go up to 525 and then pause there. Not reduce rate, just pause there, and hopefully over time throughout the rest of this year, inflation will continue to come down. So that's why I think CPI report next Tuesday is very, very important for the market, because you can see the market has a positive structure, positive bias right now. Either that bias gets validated or it gets invalidated. And if so, then we might be looking at more consolidation, more weakness, so forth and so on. Now, if we now move on to other markets, so look at dollar. So you can see that dollar has been, moving higher since the unemployment report has been released. So the level I would watch is this one, which is right here. You see there was a rejection here, and this level is around 105.64. So it's entirely possible that it can go up to that level. But if the CPI comes in stronger than expected, then I think this level could be breached and it could move higher. Then the next level would be here. On the other hand, the previous low would basically the support level. If let's say the the CPI comes in weaker than expected and the dollar market reacts negatively, then obviously this would be the next support level. If we look at gold, gold is reacting negatively as dollar strengthened. You can see that 1900 was a resistance area. You can see that it wasn't able to get through. So right now, it closed below. It's right at the previous low, marginally 1875. If there's further weakness, next level would be around 1850. You can see that the momentum indicators are moving lower. The MACD is moving lower. RSI is below 50, so it is looking a little bit weak at the moment. So we need to see what the outcome is next Tuesday, because all of these markets are going to react to the CPI report. If you look at the oil market, oil had a strong day on Friday. It was up 2.73, but the level to look out for is this one. Whether or not it can get through this level, 82.84. That would be the, because there's been some rejection at that level. So we need to see whether or not it can get through this level. If we look at VIX, so VIX, the level to watch out is this one. You can see there was a rejection right here. So this is, what number is that? It's around 21.78. So this would be the first level to see whether it can get through there. If it gets through this level, next level would be around 24.21. You can see there was some rejection right here. And finally, this level, 26.82 on the upside. And the downside, obviously the previous low, 17-ish would be the... but overall, the momentum indicators are still not 100% in positive territory. RSI is above 50, which is which is positive, but you can see that previously it went above 50 but then fell back below. But MACD is below the zero line, so MACD is in negative territory. So again, I would expect this market to also move from the CPI report. So all eyes are on that report, really. If we look at the bond market, you can see this is TLH and this is TLT. They're both reacting negatively so far. That's because the yields have been going up, and if yields go up further, then I see some more weakness here. Let's go back to the 10-year for 1 second. So as I mentioned, this level is very important, which is 3.9. If this level is closed above, then this sequence of lower highs is over. At the moment, it can still make a lower high. If it reverses from this level, it can still make a lower high. So that's why this you could draw a trend line and say, oh, it's broken through a trend line. But to me, horizontal levels are more important, only because it shows whether or not certain hurdles can be overcome. So this was the previous high, whether this can break through 3.9. If so, then I think a lot of markets will react. I mean, stock market, dollar market, gold, silver, all of that. Now, if we look at some of the ratios just to see what might be happening. So this is XLP versus SPX. Now, if you look at the weekly chart of this one, you can clearly see that it has broken trend line. So if I draw a trend line right here, you can see that it has broken the trend line. Now, the reason I'm showing it is because during market turmoil, people tend to move into defensive stocks. So, and you can see during the bear market, XLP was outperforming S&P 500. But over the last, since, in 2023, XLP has been, underperforming. That means investors are not concerned about defensive posture. But if you look at what's happening in the last few days, you can see that there's some indication of defensive posture. You can see XLP is outperforming S&P 500. So there's maybe some concern about this report, the CPI report. And if this CPI report continues to, shows that inflation is still a problem, then, I would expect, more, investors would be moving more towards defensive names. So I would expect XLP to outperform. So I am seeing some, defensive posturing, but on a weekly basis, it's not a significant level yet. If you look at XLU versus S&P 500, this is utilities. You can see that, broader picture is that, people are still moving away from defensive name. But if you look at the last few days, you can see that some uptick in, utilities outperforming. So it looks like, there's some defensive posturing going on there. Even dollar versus S&P 500, you can see that the weekly trend is definitely down, but over the last few days, you can see that dollar has been outperforming S&P 500. So indication that investors are looking for flight to safety. If you look at this ratio, this is TLT versus S&P 500. You can see that bonds are clearly outperforming. So at the moment, there doesn't seem to be any recessionary concern. Like during times of recession, generally what happens is that investors prefer bonds over stocks. So at the moment, bonds are underperforming stocks. So it looks like investors are not yet concerned about inflation. Not yet concerned about recession, but they are concerned about, inflation. And when they're concerned about inflation, they tend to sell bonds because yields go up. If we look at some of the sectors in S&P 500, what do we see quickly? So quickly, this is XLK. XLK, you can see that has come back to this support area. So if you look at the moving averages, you'll see that this rally had moved it way above these moving averages. So this pullback is bringing them closer to the moving averages. So this is actually healthy because once they move too far away from these moving averages, then you see some big pullback. So XLK is at least moving towards this moving averages. So long as it remains above the moving averages, that would be positive. So the levels to watch out is, this one would be the next level. So overall, the structure still remains positive. XLY, again, what it's done is that it had a massive run up. We see some consolidation, pullback. You can see that RSI was at way in overbought territory. It's now coming towards more of a neutral level. So overall structure is still intact. XLF, this is financial. Overall structure is still positive, but some consolidation, recently. XLV has come back to the midpoint of this range right here from the bottom right here to, so if it's going to bounce, this is where I would expect it to bounce. XLV. Now if it moves higher, it will at least try and hold S&P 500 up. This is the second largest sector in S&P 500. So if it moves higher, it would provide at least some support to S&P 500. This is XLC. This was one of the strong group. You've got Meta here, you've got Disney, you've got Netflix, and you can see such a massive run up. So all it's done is come back to kind of the earth, if you will. If you look at the moving averages, you can see it has now come back to the 20 EMA. It was way above the 20 EMA, and this consolidation has brought it to, so this is healthy. So what we are seeing is that equity markets are at support levels. So either they rally from the CPI report, or they break support and we move lower. So generally, when a big event happens, you tend to see this kind of things. Either market is either at support level or resistance level, and the news event happens. Either the support or resistance get taken out. Either market rallies off the support or breaks below the support. So you can see all these markets are at an important level. And Friday, next Tuesday, we'll find out whether or not they rally or not. I just want to finish this by saying one more thing about S&P 500 on a weekly basis. You can see that I've got a channel right here. See this level right here where the blue line is. This is the midpoint of the bear market decline from the top to the bottom. This is the midpoint. Now this is an important level. This is around 41.50. This is an important level. This is basically where bears and bulls are going to fight for control. And this is basically where you also see mind games going on. If the bears are able to keep S&P 500 below this midpoint, the longer they're able to keep them below the midpoint, the more doubt they can create in the minds of the bulls that this rally from October is nothing but a counter trend rally. If on the other hand, bulls are able to push S&P 500 above this midpoint and hold it there, then they would be able to create some doubt in the minds of the bears that this bear market is over. So that's why I think this level is very important. This is where you're going to see lots of indecision by market participants as to whether this rally is real, whether this is just a counter trend rally. Now, from a weekly perspective, the key is this level, 3,800. You can see on a weekly basis, it made a higher low. As long as it remains above this level, this higher low, it remains intact. But the level to watch out is this one, 3,800. Now, obviously, there'll be other levels before it, but this is the crucial level. If it goes below this level, then this sequence, this higher low sequence will be broken. But on the other hand, again, as I said, this is an important weekly level from 41.50. If this level gets taken out, then the next level would be around here, which is around 43.25. So there's a lot at stake here. Bulls and bears will be fighting at this stage. And believe me, at this point here, there's going to be a lot of mind games going on as to, hey, is this a new bull market or is this a counter trend rally? And all that is going to happen at the midpoint of this. Whoever wins, obviously will be rewarded, but lots of, people are going to be unsure. And that basically means that, you can either make a lot of money or you're going to lose money. So risk management at this level is very important. Well, I'll leave it at there. Thank you very much for watching the video.